thank you all for your patience. I know you've seen great community, great games, new technologies, but it's a VentureBeat conference, and I know you were waiting for the venture capitalists. And we have 3 live venture capitalists here on stage to satisfy it. So I'm going to introduce the people over here. On my far right and your far left, which is not representative of his politics, is Ethan Kurzweil, a partner at Bessemer Venture Partners. He leads the gaming roadmap, and his investments include Playdom, which was sold to Disney, Twitch, which was sold to Amazon, and Team Solomid, which he'll be accepting bids on later after the show. Next to him is Scott Rupp, the founding partner of BITKRAFT Esports Ventures, and who also oversees the MTG Corporate VC Fund. His investments include Tonk Tonk Games, Lofelt, and Volley, where he's co-invested with Ethan, I believe. Mm-hmm. Yeah. And lastly, the hometown venture capitalist is Gregory Milken, who is a managing director and founder at March Capital Partners. His investments include Genvid, Nifty Games, and Dorian. He is also a prolific angel investor, including of Small Giant and the Immortals team. Okay, this is a period we've been waiting for. The last time that VCs invested heavily in games was in 2011 to 2012. At VentureBeat about 4 years ago, I observed that if you went down Sand Hill Road and offered a game investment or leprosy, they'd have to think about it for a while. But now we have at least 17 venture funds across the seed through Series A and Series B who are investing, who are asserting that they will do at least 2 investments in games in the coming year. These gentlemen have been doing games before it was fashionable. They're doing it now that it's fashionable, and we look forward to them doing it after it's once again unfashionable. So can you tell us why this time it's different? Scott, you were with a company that received generous funding in 2011, 2012, so yeah. You have experience. Why is this the right time?
So a lot of reasons. So I think, put your comment in context about 17 funds, that's still a tiny amount of VC going into a $150 billion industry, right? So if you just do simple math and think that's 35 investments, that's low hundreds of millions of money going into a massive sector, which I think is pretty underfunded from a VC perspective. In terms of what's different this time, I think the main difference, if you look now versus 2011, back then, people didn't know what they were doing, frankly, right? Like all the VC money was going to fund people to make MMOs and online games who had never made an MMO or an online game before. They were largely coming out of console. Remember, this was right around the time of the birth of the iPhone. There wasn't a human capital pool of developers who had made free-to-play games. So I think the knowledge base was totally different than it is now. A lot of that VC money went towards educating people into how to make server-based games. I think the other big change is obviously tools like AWS is a huge simplifier of part of the puzzle of making games. Unity was just getting started back then. Unreal is incredibly powerful now. So I think the enabling tech is much better now. We're starting to see some changes on the distribution side as well, especially this year, where you can de-risk a lot of the games investments that you're making in ways you couldn't before. And I think the final big difference is back then, there wasn't this ecosystem of specialized games-focused seed funds. And so it was a lot of generalist funds making quite big bets as opposed to small, $1 to $5 million bets. And so a lot of people lost big money as opposed to a more diversified ecosystem spreading bets around a lot of different companies.
Well, certainly one of the key differences is that there's the seed funds out there. They simply did not exist. But what you described is that the last time the generalists or the Series A and Series B missed because they didn't fund they were funding the last generation of people who had done the last generation of games. So that works in this cycle if games are not going to change going forward. In other words, if the skills that were perfected in that fund, or is it just that we're going to be doing more and better?
Yeah, I mean, that's part of the fun of the industry. It always changes, but I think it's still a good moment, I think, to be investing in free-to-play multiplayer games. And that proposition from a human capital perspective today is totally different than 8 years ago.
Yeah. Well, I'd also say looking down the road, I think there's more acquirers today than there might have been before. So the fact that you're looking at, Facebook, Tencent, Google, Amazon, it just seems like there's more companies out there, large scale, that are willing to acquire games and game developers. So more money pouring in because I think people see more ways to exit the space.
Yeah, and I think the IPO markets are opening up for games companies in the Nordics especially, so there's other channels there too.
So I don't disagree with anything you said, but my meta view is that is the same cycle repeating itself all over again. I mean, when I first became a VC, I started in 2008, and there was all this excitement over, the iPhone had just been released a year before. Social gaming was this tremendous accelerant to platforms. You had companies like Zynga and Playdom getting big almost overnight. And you had the enabling technologies of the web, namely JavaScript development, and then later the enabling mobile technologies were sort of ubiquitous to developers. And those were sort of the accelerants that led to a bunch of interesting game technologies and some really big successes and some big flameouts that led money to leave the industry. And so I think all the accelerants you mentioned are real, and they'll be real for some period of time until they're not anymore, until there's some new platform or some new accelerant. But I don't see this cycle as much different than the past ones in that you have all this excitement, you've got lots of money, some smart, some less than smart, some lucky money coming into the space, and there'll be sort of this washout of folks that invest in the right things and those that don't, and I'm sure we'll go through another trough of disillusionment where folks say, oh, well, that didn't amount to what I thought.
Yes. So what Ethan is referring to is that there's a cycle, and over the 40 years of venture capital, there has almost always been overinvestment in fields. The most recent one that most of us would have experienced was in VR, and to a lesser extent in esports, which we'll talk about later. But the thing that you need to look for is what level of exits there are.
That's a great segue, actually, because I remember starting out as a games investor. We made an investment in Playdom in, I think it was 2009. The company sold in 2010. It was sort of the height of euphoria. And the questions then were, well, why did you sell it? You were on this path with Zynga to become this multi-billion-dollar company. A year later, the question was, thank God you sold it when you did, because that whole industry came crashing down a year later. And so that between 2010 and 2011, 12, when sort of mobile gaming really had its initial ascent, the view of social gaming there was just a totally different view. And so I do see some parallels now. I agree with Scott. I think we're in for a much longer, more sustained, frothy period here, but there'll be the other side of that coin at some point.
Yeah, I think just one other difference I'd point out is I think if the cycle turns the wrong way, I think the black eyes this time are going to not be as bad, right? Because the period you're talking about, people were putting in 10, 20, 30 million to figure out if an MMO company could work, and that was how much time and money it took. That's not what you need to do today, right? You're taking much smaller individualized bets to find if a company and a product's getting traction. So I don't think some of the misses will be as painful.
Well, let me push back. Some of the VR companies are taking tens of millions. I mean, there's a company that raised 70 million this year.
But I'm talking games.
Yeah, but it's interesting, Scott. What you're arguing is that the venture community as a whole is going to show moderation in the middle of an investment wave. It has happened, but that would certainly be a contrarian prediction going forward. If that happens, I'll be fascinated.
He gives us more credit than I think.
But what I will say, to do an advertisement for these three panelists, is if you are looking who are going to be the likely successful investors, VCs as a group are a bunch of very intelligent people. The issue is whether or not they are smart. And they often are smart about fields like enterprise software, which they invest year after year. In games, like any other field, you want people who have been doing, the people who are likely to succeed are the people who have been doing games. Gregory, you started this you started investing in games in probably one of the worst periods for games venture capital, and now have about 5 years behind your belt. Now that you've been through one or two cycles, which sectors are the ones that excite you the most going forward?
Well, esports, competitive gaming, I think are ripe for opportunity. Obviously, there's been a lot of money into the esports sector, but if you look at what way people are monetizing, there's lots of opportunity there, beyond fans being engaged with content, teams playing competitive games, and just the immense amount of time that they spend watching and consuming that content. I think there's multiple ways to monetize them that we haven't seen yet. If you look at traditional sports that are monetizing at a much greater rate than they are in the esports space. So I think there's lots of opportunity there that hasn't been fulfilled yet. And then just the general sense that people are online playing against each other all the time. So broadening from esports just to the idea of competitive gaming, and that people want to compete and play against each other all the time has really opened up the gaming space.
So you're including esports and competitive gaming and presumably spectating too then?
Oh yes, monetizing viewers and having viewers as participants in games, is a huge opportunity.
Right. Ethan, your commitment to esports was sufficient that you hired an esports lead to work with you on that. So where are you excited about esports? And then, of course, Scott, as BITKRAFT esports can bat last.
Yeah, we did, because it's an idiosyncratic enough field that some expertise is helpful, although he's since moved on to be the number 2 exec at 100 Thieves, and so I'm on my own again. But I echo what Greg said. I think you've got the potential sort of overlap of 2 really powerful monetization schemas: the sort of media viewership regime that we have for traditional sports, sponsorship, advertising, things like that, and direct pay, subscription-based models that you really don't have with traditional sports. You don't, maybe a little bit now with premium viewing of the NFL and things like that. But it's for gaming, you potentially have kind of a second and third revenue stream built in there. And so I think it's an incredibly exciting world, and figuring out what are the right investments to make within esports. That's the challenging part. That's why we brought in someone to help us with it. And we're early to it. I sort of saw it happen as an investor in Twitch. But remember, we sold Twitch 5 years ago, almost 5 years ago now, and we didn't turn back to making esports investments until a year and a half ago. So during that time, there was still a lot of, even though the viewership was there, people were watching games, the viewership of Twitch was over 100 million monthly active viewers when we sold the company. The revenue streams and the businesses had not yet sort of come on. And to some extent, that's still happening today. I think some of the esports teams that we're invested in, they're starting to see major sponsorship sales and major 8 figures of revenue and growing healthily. But they're kind of at the tip of the spear. There's a lot more to come, and trying to figure out that world is what's interesting.
Okay, Scott, since you were taking notes and your colleagues were taking notes during the 3.5 years that Ethan was taking a hiatus, you do certainly in the West the most number of esports investments, and the parent company bought ESL, which is probably the earliest Western success. I think it started in 1999.
Yeah, around there.
Right. So, where are you seeing the most interesting bets in esports?
Yeah, so we focus on 4 areas. This relates to our overall fund strategy. So the first is we are investing in games. We do want to invest in the next wave of great competitive multiplayer games, mobile PC. And part of the thinking underneath that is we have a big enough fund where we can make 8 or 9 bets like that and kind of diversify out some of the risk of games investing and still capture quite a bit of upside if one of them or 2 of them works. So gaming is an important part of our strategy. The second, which is maybe a little different than other mainstream VCs, is we're really interested in lifestyle brands for gamers around esports culture. And here the inspiration is what we see in action sports, and you got Billabong for surfing and Vans for skating and Burton for snowboarding. And gaming really doesn't have those brands except for around the teams, obviously, and some hardware brands, but there's no nutrition brand for gamers. There's no fashion brand for gamers. So we're doing some things like that, which we think you can pick up some of the playbook around how do you build e-commerce businesses and digitally native brands that are relevant to today's generations. So that's the second. The third is we look a lot at, we call it horizontal technology. It's basically interesting tech where games becomes its first kind of real consumer use case, if you will, that can then fan out into other areas, right? So if you look historically, obviously, games and esports is where live streaming was born. It's where, you know, first real need for high-end graphics cards came, and now we're in a moment of AI being adopted by game companies, blockchain being used by game companies, changes in networking technology. So we'll do investments like that. We've done 2 recently. One is LA company called Network Next, which is doing an internet fast lane for gamers. How do you make a super low latency, high connection environment for League of Legends players to give them a great experience and help the publishers retain those super valuable players. But once we kind of build that supply, if you will, on the bandwidth side, there's a lot more we can do with it outside of gaming. We did a haptics company called Lofeld, which is kind of trying to create the Dolby standard of haptics and makes it much more high def and modulated in the types of experiences you can provide with really easy software integration in the audio files of the games themselves, so that it's easy for developers to turn on. And that'll go into beyond games, into automotive and healthcare and other categories. And then the last category we look at is a little bit of a catch-all, but platforms, things that are aggregating audience and monetizing them, whether that's esports betting or streamer communities, or one we did announce today actually called Go Meta, which is a platform that makes it very easy for people to create interactive content in games and to stand up software projects.
Yeah, to pick up on something that Ethan pointed out earlier, a lot of the professional sports teams, the billionaires who own football teams and basketball teams, have looked at esports teams and said, oh my God, you guys are so primitive in terms of things, in terms of reaching out to fans and so on. There's a whole bunch of bricks and mortar businesses, which I think you were hinting at with the lifestyles play is one of the things that you do. But once you get people in and get them in, there's a whole set of support services. To go to the next thing, just because we have to watch the time. For many years, VCs have had an aversion to investing in game studios because the logic is it's a risk on a risk. You're betting on someone producing a hit game, and VCs are already in the hit business. They're placing a number of bets, they're diversifying the risks. This group, however, shocked me because every single one of them is investing in game studios. And Ethan, in fact, recently invested in this is not public, a South American game company, which we're filing off the serial numbers. But why would you, as Bessemer, one of the great traditional venture funds, go against the grain and go after a game company at an early stage?
Well, I think, just to be clear, that was 4 years ago, although we would do it today too, so it's no different. We don't, it is a bit of a contrarian or counterintuitive thing to underwrite to as a venture capitalist because of what you said, because of, hit-driven things are very hard to predict. So I don't disagree with that, and I wouldn't bet on something where I couldn't, with some reasonable degree of conviction, say I think these guys have a better than average chance of succeeding, or the success would be worth the sort of risk of the investment loss. And so there are some cases though where you can do that, and it's usually not just someone with a creative inspiration or a really good games concept. It's some particular edge or advantage, or taking advantage of some platform shift. In the case of the South American studio, they were just amazing at figuring out how to monetize mobile very early on in a very under-the-radar way, and have continued to sort of build that capability over time in a way that, despite all the tricks being known, they were still doing better than everyone else, even at the scale they were at. And so that felt like a viable investment to make, a viable bet to make. There are cases where there are new platforms, they create new opportunities, there's new concepts, new mechanisms for propagating games virally. That's what Playdom and Zynga were back in their era. And so we can get excited about something like that, where it's kind of following an established trend and just trying to out-innovate by a little bit more of a clever game. I'd probably fall in line with all my other colleagues who just say, I don't know what's going to work. It's a little hard to tell. But I think there are a lot of things where you can say, this is clever, this has some edge versus all the other things that have been tried before.
So Gregory, you are such a conviction player in game studios that you are willing to continue doing despite having invested in Wavedash, which was one of the more notable crack-ups on the highway. Can you describe what you've learned from that, or is it an aberration and it's an outlier and therefore you'll keep going on?
Well, I don't know, that's an aberration. Companies are going to fail. I mean, so you may say investing in game developers is a risk upon a risk, but venture's a risk. That's why I'm in the space. I mean, I'm betting to win big, and not everything's going to win. So there's going to be game companies that fail along the way. So, I mean, I view it as, I'm going to make enough investments, hopefully in enough game developers, that some of them are going to succeed big, and that's going to, help the ones that fail. In the case of Wavedash, I think when I invested, I believed in their thesis that there was a broader audience for the fighting game community that could be mass market. We might have had some execution issues with the company and everything didn't go perfectly, but maybe that fundamental thesis was originally wrong. Maybe there isn't that mass market out there for the fighting game community that I thought there was. But doesn't mean back in that time that I wouldn't have taken that bet. I would still take that bet at that time. And I'm still going to take bets on things that are highly risky for game developers because, I think venture is built on disruption. So if you're not trying something risky, you're not going to succeed big.
So I had asked these gentlemen not to advertise too heavily what they did, but now I want to advertise for them. In VC, and if you want to go after the companies in your sector, you want to go after the firms that have had failures and continue to make investments. And one of the reasons, for instance, Gregory talked about his, Scott has a few, which we don't have time to go into right now, but, and Bessemer is a firm that earns a certain amount of respect because they listed their anti-portfolio. If you go to their website, they list their most spectacular failed investments, including that they passed on Federal Express 7 separate times. You want to deal with firms that tell you things like that. So you want them to have successes too, but
yeah, you want a mix of both. And to be clear, we list the investments we didn't make that we should have, like FedEx and Google and PayPal, and I don't need to go through the full list. You can read it later. We don't put up the massive failures on our website, although we would do that too, but we don't want to. Our entrepreneurs wouldn't like that, but we definitely, when something like what Greg was describing happens, you do go back and you try to revisit. All right, what did we get wrong? Was our thesis right? They just didn't execute well, or were we wrong about these people, or did something happen that just was unforeseeable, or did we just mess up in our diligence and we missed 14 things? I had one investment, not in gaming, it was in another consumer app where I just missed some things during the diligence and found out later it was not quite what I thought. Was it that kind of a scenario? And so, but you can't possibly be in this job and not have some of those failures, or it's an occupational hazard you want to avoid.
Actually, Ethan was not telling the truth. They do list some of their failures, but they wait till the statute of limitations has passed. You have the Honolulu Railway.
Oh, that's true.
You invested in that 100 years ago, and the founders are not upset that you listed that failure. Anyway, moving on to other categories. But again, you want people who will pick themselves up and who will stay with you. As Gregory points out, this is a risky business. How do VCs react to failure is as important to most of you, more important to most of you than how they react to success. Anyway, in terms of interesting areas to invest in, you, Scott, you had some thoughts on whether or not it's time for a new platform. So can you define what type of platform you think there's the greatest chance of there being
I think that was his.
Oh, sorry.
Oh, the platform.
The other Scott, Ethan, my apologies.
I'll play Scott. I think by platform here, I mean like a new mechanism for distributing games. And I've noticed in a lot of both successful game companies and a social network like Discord have tried to go into this sort of platform area of we're gonna provide a new distribution mechanic for games. Now that's 2 data points, and I hear this a lot in pitches where they have a little bit of consumer success and that's the end goal. And it made me think, is there anything to that? Is it time for a new Steam or a new distribution mechanic? Or is that just a hope that a couple of entrepreneurs put on a pitch and really we're not, a platform shift will come through VR or whatever's next in terms of more immersive gaming tech? And so I throw the question out, I don't know the answer. It's not part of our roadmap for the space in that I don't think you can underwrite to somebody creating a platform, but there's some very big game companies now that have the potential to do it, and I think we are ready for that shift. And so I'm anxious to see if that happens.
Okay, well, there's an argument for the progressive web.
Yeah.
So in terms of a distribution, you want to, I want to get this question to you one way or another.
Yeah, no, I think building on what Ethan said, we're starting to track this whole progressive web app phenomenon, which is, without getting too technical, sort of a way to offer app-like experiences just with web-based software. So no downloads, no installs on your phone, no app stores. And now kind of what you're able to do from a gameplay perspective is getting pretty darn good. Some limitations on what you can do graphically, but I think if that takes root, that will be a totally new way to start to distribute content. And it'll change the economics if these games can get out of the app stores. So that's one we're tracking. That was part of what was behind the Go Meta investment today, actually.
What about cloud gaming? Are you looking at that as well? Those announcements there?
No, short answer, no. Just because I'm not sure exactly what the sweet spot use case is going to be, and whether there's a place for startups to play in that fight.
Okay, so we talked earlier about the need for capital efficiency and whether there'll be too much capital. Gregory, you also raised a question about what can happen with valuations with all these players crowding in the space. Yeah,
well, I mean, I think particularly when you talk about esports, I think a lot of people think that some of the valuations in the esports space have gotten out of whack. So, I think in March we try to be diligent, and if we think valuations are too high or companies asking too much, we'll walk away from it. So, I think, having some diligence and being, strict about what you believe is the potential exit value is important when you're investing, because you have to look at what a company can IPO at or be acquired at. And if, you're investing at a valuation that's not going to get you, a significant amount of times of your money back, then it's not really worth making that investment. And I think some of the things in the space, some entrepreneurs and some VCs are just too aggressive and allowing those valuations to climb early. And I don't want to be investing in down rounds. So I think we try to be strict about not, letting a valuation climb up as it does, I think, when sectors get too hot.
Right, so how many years out are you assuming you're investing? When you're looking at the average, again, are you looking at 5 years? Are you looking at,
Well, I think it depends what stage you're coming in at. If you're coming in at A,
Eric,
then, we're thinking, 7 or 8 years probably, so.
And so on. And what about the potential, what about the issues of most LP funds are around 7 years in terms of their main life, and then in terms of game companies. If you invest in year 3 and you need 7 or 8 companies, is there any conflict that's inherent in that?
There could be. I mean, I think we try to be upfront with my colleagues, maybe with our LPs, that when something's going to be longer. I mean, particularly investments in the esports space, I think, are going to take longer than people think. So when we discuss it and choose to invest, we're talking, about 7, 8 year horizon rather than a 3 to 5 year horizon.
We plan for 10 years. I mean, wouldn't be realistic to. These are illiquid markets, so you can't say, all right, our 4 years is up. I want to get my return now. It's not a stock that you can do that.
But in terms of companies, we've seen, for instance, game studios have the issue that if their first game does not produce great results, then there's a gut checkpoint with VCs. What would be required to get you to reback a game studio that came up with its first game? It didn't fail, but it didn't produce a return, or is that basically on to the next one?
I mean, I think there has to be a clear plan for what worked, what didn't work, why it worked or didn't work, and what their fundamental belief is about why the next round is going to be better. But also, I mean, if you're backing companies like mobile game developers, you probably want to back them so they can iterate and produce 2 or 3 games to get to that success. So when they're raising capital, you want to think about raising capital to have a couple at-bats, particularly on the mobile side, because the first one or the first crack at it generally is not the success. And if you're just funding for that, it's not a good idea.
Okay. The shorter thing is that you should understand where your interest in the VCs may diverge. You can address it, but the issue is these are the sorts of things you should know up front. And with that, we're out of time. I'd like to thank Ethan, Scott, and Gregory for joining us, and thank you all for coming.